Hey everyone, welcome back to another exciting Rocketblocks mock interview. Today we've got a brand new case titled Retail Rumble. In this case, a major pharmaceutical chain called HealthPlus is grappling with prescription drug declines and fierce competition which are impacting profitability. In this case, the candidate is expected to analyze the challenges, explore strategic responses, and provide recommendations for HealthPlus to improve its bottom line. And joining us today is Ashwin Shetty, an ex-Bain and Company manager and Deloitte director. Our brilliant candidate for today is Abigail Doekson, an ex-BCG consultant who is currently completing their MBA from Yale School of Management. So without further ado, let's get started.
Welcome, Abby. I'm Ashwin, former Bain manager and a Deloitte director, and I'll play the role of an interviewer today.
Hi, everyone. My name is Abby. I completed some internships at Microsoft and Deloitte, spent a couple years at the Boston Consulting Group, and then spent a couple years in private equity as well, but currently an MBA candidate.
Great. Thank you. Thank you, Abby, for doing this. I have a healthcare case for you. I hope you enjoy healthcare as a sector. And let me go into the case prompt. HealthPlus, the second largest retail pharmacy chain nationally, is feeling the pinch from a changing market landscape. Recently, there has been a major change that has shaken up the retail pharmacy industry. Prescription drug price reimbursements have declined by about 10%, resulting in a major hit to the industry's top line. Now, this decline, combined with fierce competition from brick and mortar players and online retailers, have resulted in significant decrease in HealthPlus's profitability. Client is asking you to recommend how they should respond.
Great. Thank you so much for the background there. Couple quick clarifying questions. So recognize they're the second largest retail chain, pharmacy retail chain nationally. Just to give a sense of their breakdown in revenue, what are kind of their key segments within revenue, or how do they segment their revenue streams?
Yeah, so the revenue breakdown is 70% is prescription drugs, 20% is OTC or over-the-counter drugs, and 10% revenue comes from health consultations.
Fantastic. Thank you. One more quick clarifying question. Don't have a large background in healthcare, and just wondering if you can provide a bit more insight or detail on how exactly decreased reimbursement rates for prescription drugs impact HealthPlus's profitability.
Yeah, that's a good question. Now, HealthPlus, like other pharmacies, operates on a reimbursement model where they buy drugs and they get reimbursed by insurance companies. However, reimbursement rates have been falling. So last year, there was almost a 10% decline or 10% cut. As a majority of HealthPlus's sales that you just saw from the revenue breakdown comes from prescription drugs, this has had a substantial negative effect on their profit margins.
Great. Thank you so much. If you don't mind, I'm just going to take a few seconds to gather my thoughts and kind of write down how we'll go through this problem together.
Yeah, go ahead, Ab.
Okay.
Yeah.
I have an idea of how to just sort of think through ways to solve this profitability problem, or think about the profitability problem. And at the core, they really need to increase profits, right? And so I'm thinking of dividing this into kind of two buckets. One, we can either improve their top line or their revenue to increase profits, or two, we can improve their bottom line or reduce costs to increase profits. So within that first bucket, improve top line, two kind of things come to mind. Kind of A would be increasing the diversification of our revenue. So 70% of revenue today is from these prescription drugs, as you mentioned, which means they're going to be fairly impacted by declining reimbursement rates. But maybe there's a way to grow their over-the-counter segment more, potentially reaching out to new customers or trying to market to customers to really push their OTC sales, or grow within their retail stores. Maybe there's other services that they could offer and grow that 10% kind of services bucket that you mentioned. So really just diversify revenue away from that 70% from prescriptions is kind of my first thought of a way to increase profits. Kind of point B, another way that we could improve profits by increasing or improving the top line would be perhaps we expand into new sales channels. Maybe we increase our digital sales or do a digital transformation to try to grow sales through an app or through our online website. Because I imagine, the prescriptions are really based on in-store sales. You go to pick it up, but maybe by kind of increasing our focus on other channels, we can grow revenue away from that as well. So just perhaps a digital transformation, improve user functionality of the app that we may already have, build an app if we don't have one. So that's kind of my second idea for improving the top line. And then the bucket 2 I mentioned, improving the bottom line. A couple things come to mind within that. I guess A would be store optimization or potentially closing some unprofitable stores. So if we're having kind of a decline in profits, maybe it's focused within stores in certain regions or certain geos, and having kind of a look at stores and see if we can reduce the few that are unprofitable if it's concentrated in a few stores, and that could improve profits. The second one I was thinking about kind of within improving bottom line is potentially we increase kind of cost efficiencies on a per store basis. We could improve kind of labor efficiencies per store. Maybe you hire fewer people at a time working in a store. Maybe you have supply chain or sourcing efficiencies where you could kind of bulk source your goods for all stores within a region and potentially save on some costs for those retail items. So there's maybe some things that you could do on a kind of a per store cost or profitability basis. But overall, those are kind of the buckets I was thinking about in terms of how to view or further analyze this profitability problem.
Got it. Great. I like your classification here, Abby. The revenue versus the cost reduction versus the revenue enhancement initiatives. Which of these initiatives that you have listed, right, or the strategies that you have listed, you think will have a more immediate impact to the client?
Good question. So most immediate impact. Well, if we think about kind of the top line buckets, revenue diversification or expanding channels, I imagine those would take some investment up front, kind of hockey stick growth, which means it likely won't be immediate. It would take some time. So it wouldn't instantly kind of solve this profitability problem. So not those. If I look at the bottom line buckets, store optimization or closures, you likely have to take some action to close stores, but it'd likely be fairly immediate. If you have an unprofitable store and you close it down, the profits per store bit, the labor efficiencies or supply chain efficiencies that I mentioned, that might as well take some investment, specifically on the supply chain side. You have to probably invest some time into initiatives to improve this profits per store. So kind of reviewing that, I think the store optimization / closures would be kind of the most immediate avenue to take to improve profitability in the near term.
Got it. Great. Thanks. Thanks a lot, Abby, for that. Now, let me share an exhibit with you on clients' profitability. Now, what I want you to do is, Abby, if you can share key takeaways from this exhibit that I'm sharing with you.
Yeah, let me quickly scan this. So looking at the exhibits, I see we have kind of a breakdown by market of number of stores, number of profitable stores, revenue, costs, and profit by market. And then we have the total, it appears, for the entire company as well. So looking at these two tables kind of side by side, the first thing that jumps out to me is, one, they've already started closing some stores. So 5 years ago, they had 212. Today, they have 190. So they've already closed, 20 plus stores, and maybe they've already started taking some action into closing unprofitable stores. That's kind of the first thing that jumps out. The second thing is, when we look at kind of this column of number of profitable stores, that means our hypothesis of maybe profits are concentrated in a certain or in particular stores is true. There are only a few profitable stores. Specifically, if we look at today, it looks like about 61 stores are unprofitable, or 30-ish% of stores are unprofitable. And going back to our original framework, maybe those would be stores we could consider closing. So that's kind of the second thing that jumped out to me. The third thing that jumps out to me, if we just look at the total profit today, A, B, and E look like at quick glance appear to be the least profitable. And E in particular, if we look at 5 years ago, was also unprofitable 5 years ago. So if we were to maybe prioritize our analysis, maybe we start with E and A and B, looking at stores in those specific markets to see if there are any that are particularly unprofitable that we could look at closing.
Got it. Got it. So great. I think good observations there, Abby. Right? Do you think decline in profitability is largely driven by a decline in revenue, or is there any other factor that is causing this decline in profitability?
Yeah, that's a great question. Well, it looks like revenue has declined about, it looks like, I want to say that's 500 million US, assuming that US dollars here, where costs have also declined. So if costs are declining and not going up, I'm going to hypothesize that this is more so driven by declining revenue.
So Abby, what I want you to determine is what was the change in average profit per store from 5 years ago to today?
Okay. So just structuring this out here. So change in average profit. So need to calculate 5 years ago and today. So starting with the 5 years ago, we had about 116 million in profit divided by 212 stores. I'm going to simplify and round and say that's about 120 million in profit divided by 210 stores, which is equal to, if I narrow that down, about 6 divided by 10.5, or just shy of around 60%. So if I apply that to our original, we just have a multiplier here, that should give you to just shy of 600K profit per store. So I'm going to say about 550K of profit per store 5 years ago.
Yeah, that's right. Yeah.
Okay. And then if I look at today, we have negative 143 million of total profit divided by 190 stores. So I'm going to round and say we have, negative 140 million in profit divided by 190 stores, which is equal to about 14 divided by 19, or that's about, probably just shy of, or just above 75%, 14 divided by 19. So if I apply that to kind of our original profit estimate for the beginning digits, that's about negative 750K profit per store. So if I'm looking at this, profits per store have declined about 1.3 million per store.
Yeah, that's a remarkable decline, isn't it?
Yes, it's quite large.
Yeah, so great. So again, staying on this exhibit, can you estimate how much money each unprofitable store is losing today?
Yes. So if I just focus on today, we have negative 142 million or 143 million of profits. And then we have unprofitable stores would be 190 minus the 129. So divided by 61 stores, that's equal to, if I round, about 140 million divided by 60, or 7/3, which is going to be about, 2.3 to 2.4 million per store. That's assuming that our profitable stores are just breaking even, though. So that's kind of the baseline floor of sort of how much profit each of our unprofitable stores are losing. If I simply assume that, each profitable store, so that's about 130 of them, is earning, I'm making this up, but let's say 1 million in profit, that means our unprofitable stores will have to counteract that positive profit earned from our profitable stores. So if each store is earning $1 million in profit, that's 130 stores times 1 million a piece. So if we take that 130 million of positive profit divided by our 61 stores that are unprofitable, we get about another 2 million in profit loss per store. So based on that, if we add that 2 million to the original kind of 2.3 to 2.4 million per store that we're losing, assuming that our profitable stores are just break even, that gets us to about, 4.3 to 4.5 million or 4.4 million in profit loss per store. I'll round there and just say about, 4.5 million of profit loss per store is my estimate, but that's based on a very preliminary assumption, assuming that each kind of profitable store is making about $1 million.
Yeah, but that's a good estimation, right? I think the assumptions that you've taken are reasonable. And let's again go deeper into this specific exhibit. You can see that client has already begun closing stores, right? There are 30 fewer stores today compared to 5 years ago. They have to optimize their store footprint essentially to improve profitability. Now, what factors should the client consider on a store-by-store basis to decide whether or not to close a store?
Yeah, great question. I think, three things sort of come to mind. One would be kind of the financial performance or the profits per individual store. So maybe looking at profit margins per store and seeing if there's some that are particularly unprofitable versus some that are maybe closer to break even, right? So just because a store is unprofitable, it might that could be at varying scales across stores. So maybe you're looking at financial performance kind of on a per store basis would be the first thing that they could look at or consider. The second thing is, I would think about kind of market size per store, which speaks to kind of revenue potential per store. Because if you're in a large or growing market, but the store is unprofitable today, maybe it has a lot of potential, and in 1 or 2 years, it could be one of our more profitable stores. And so you really need to think about potentially the market that each store operates in, or the TAM or total addressable market for each store, and how addressable is that. So that's kind of the second thing I would consider. And then the third thing would be, I would probably look at a geographic map of all of our stores and consider kind of the locations of the stores relative to each other. Because if you have, say, 5 unprofitable stores in one suburb, perhaps if you close 4 of them, the sales from those 4 could move to one of them, and then you get scale effects, and the store, that one sort of superstore, could be profitable. So maybe there's some scale effects of consolidating smaller footprint stores in one area, and rolling those sales into maybe one more parent store, I'll call it. But that's kind of, I guess, the third bucket in summary is looking at kind of the geographic footprint of our stores, in particular our unprofitable stores. So those are the 3 factors that I would consider or look at.
Yeah, I think it's a good way to look at it, right? Financial performance, potential, and the geographic footprint. So great. Let me stop the share of this particular exhibit because I have to share one more exhibit with you. And let's focus on market E specifically, right? Now, in terms of this particular market, what I want you to do, Abby, is which stores do you recommend closing in market E and why?
Okay. Let me just quickly scan the exhibit. So it looks like we have for market E, every store, their revenue costs and profits. So we could probably get profit margin per store from this. Okay, so which stores would I recommend? So going back to the framework that I just mentioned, which is kind of, profits or metrics per store, the TAM, and then maybe some efficiencies or the geographic scale efficiencies. So starting with kind of the per store metrics, if I just look at this chart, if we can see that stores 13 through 18 are unprofitable today. So my initial recommendation based on that original framework would be potentially we look at closing stores 13 through 18, maybe even 12, because it's very low profit. So those, I don't, about 7 stores, it looks like 7 stores, maybe we consider closing based on that. But if we go back to the framework, the second thing I talked about was market potential. Maybe there's one of these stores in 12 through 18 that just is in a larger market. Potentially, I'm looking store 14 that has the highest revenue. Maybe we consider keeping that store open because it's in a larger market. So we just need to do further analysis there. And then that third bucket in kind of the framework I mentioned in terms of geographic efficiencies, maybe all of these stores are in one location, and so we should keep one open. And so would want to look at the geographic breakdown or the geographic locations of these stores as well. But just given this exhibit and the information we have, I would recommend closing kind of stores 12 through 18, but would like additional information on kind of the market size and the geographic locations for each of these stores as well.
Got it. Great. I like the fact that you use the framework that you introduced in the earlier question, right? So that's great. So wonderful. I mean, we have gone through a lot of analysis here, Abby. What's your final recommendation to the client? What should they do next?
Yeah, definitely. So if I was talking to the client, I would say, you all have experienced this decline in profitability and asked us to help you with that, exploring options to improve profitability. We explored a few options, both in terms of improving the top line, such as diversifying revenue, and we also looked at, some bottom line improvement options, such as store closures or increasing profits per stores. And based on that analysis, we decided that the most immediate kind of action would be store closures. If you really want a near-term impact on profitability, that's kind of the most immediate. And so we did a little bit of deep dive into the profits per store, and we found that the decline in profit or the negative profit was concentrated kind of within market E. And within E specifically, there were about 5 to 10 stores that were contributing to the negative profitability. So based on that, we would recommend that you close, 5 to 10 stores within market E. However, before doing that, we think further analysis would be needed to kind of look at the market growth potential or the geographic locations to see if there's any priority stores you want to keep open within those 5 to 10 unprofitable within market E. And we're happy to help you kind of conduct that further analysis. But based on our work to date, our high-level recommendation is closing, 5 to 10 stores in market E.
Got it. Great. Thank you. Thanks a lot, Abby, for doing the case with me.
Thank you so much. I had a great time.
Hey everyone, it's Kenton Kovesky here, the founder of Rocketblocks. Thank you so much for watching this mock interview video. I hope you found it informative and helpful as you are getting ready to prepare for your own interviews and hopefully landing that job offer you are excited about. We have a ton of great content on the Rocketblocks channel coming out on a weekly basis, mock interviews, mini lessons, and chats with our Rocketblocks experts. So if you haven't subscribed yet already, please do so. There is a big red button below. And if you hit that, you'll get all of our content as soon as it comes out. Thanks for watching and have a great day.